I hope we are set up and ready, and welcome to today's episode. Today we opted to do something different. We are doing a live session, and it's a course. It's a course on investing. One of the things that we constantly channel is financial literacy, personal finance, how to save, invest, earn more money, and uh, all those other stuff. And so I made it an effort that we shall look at investing. And so this is a comprehensive course, and we shall be looking at a number of investment channels, such as investing in bonds, investing in real estate, investing in agriculture, in private equity. After the stream live, this recording will be available for anyone interested to just do a follow-up and follow up on what is happening. So without further ado, let us keep going. Just before we start, I'll make some adjustment on my so investing is a crucial topic, and one of the challenges that most of us go through when we are looking at this topic is not knowing exactly where to begin, what to do, the options that are available for us. And that is what necessitated this topic today. And so we shall be looking at introduction to investing. This is our course outline: introduction to investing, stock investing, bond investing, real estate investing, investing in agriculture, private equity investing. We shall go ahead and look at commodities investing, risk and management diversification, investing tools and resources, and finally, we shall look at behavioral finance, and investor psychology. It's important to note that investing is more than a physical activity. It's a behavioral activity that once you understand and unlock, you'll be able to really master this aspect of investing. So as we go through the topic and the content, understand that investing is most focused, is a psychological activity, and you have to sort out your psychological bit first before you start the actual investing process. And so the first chapter is the introduction to investing. My orientation is tilted, so as it's being worked on, you shall bear with me so that we know what to do. So, introduction to investing. Let the relation will be sorted out later on. So, there is a difference between investing and saving. Most of us get that bit mixed up, but in a nutshell, for investing, you commit money or any capital that you have with the expectation of generating income or profit over a certain period of time. So you are basically putting money aside for purposes of growth, for purposes of that money generating more income. On the other hand, to save money, it focuses basically on preserving capital so that whatever money that you have is preserved and doesn't get lost. So investment aims for growth through risk-based opportunities. And why do people invest? People invest money for various reasons. The first basic reason for investing is to grow wealth. You invest money so that whatever wealth that you have can be multiplied over a certain period of time. Reason number two is financial security. People invest for purposes of securing their finances. The reason number three, passive income. Passive income is money that you don't work for it actively. So when you set up your money, when you invest, you're sending your money on a mission so that it can go and multiply and bring back some other more money. And then finally, we invest for economic growth reasons. In this table, we discuss the difference between investing and saving. So we look at it under purpose, then purpose, risk, returns, as well as time frame. So for investing, the purpose for investing is to grow wealth or to multiply wealth. And the purpose for saving, on the other hand, is to preserve capital so that whatever money that you have isn't lost. The risk for investing is moderate to high, and the risk for saving is low to actually none, because when you're saving your money won't get lost. You'll have that whatever money that you are saving, that money will be available, and the risk for it getting lost is very minimal. Now, what about the returns? The returns for savings are a bit low, 1 to 2% in a savings account, while the returns for investing can be relatively higher. We are talking about 4%, 5%, all the way up to around 18%, depending on what channels you are investing your money in. Then on the time frame, you can save money for a short period of time, but for investing, you invest money for a long period of time. Talk about 2 years, talk about 3 years, talk about 10 years. And when you're talking about government, like for example, government bonds and government bills, this money can be invested for a very long period of time. While for saving, you can save money today, and when you have an emergency tomorrow or the day after, you go and withdraw your money to use. So those are the distinction between saving and investing. We have looked at distinctions under purpose, under risk, under returns, and under time frames. Then as you are going through this, when you have inquiries, just leave them in the chat box, then I will have a look at them, or one of the people in our team will have a look at them. Now that you've looked at the difference between saving and investing, it's just wise enough that we go ahead and look at types of investments that are available in Kenya right now. So there are many types of investments that we can talk about. There are so many types of investment that we can explore, but we shall look at those that are essential to us right now, those that can give us returns after a very short period of time, those ones that are stable, those ones that have been proven to give yields over a long period of time. So you have got stocks, then you have got government bonds, then you have got real estate, commodities, private equity and venture capital, then you have got other alternative investment channels. So them briefly, and then we shall start looking at them in depth once we move forward. So, starting with stocks. What are stocks? When you buy shares in a company, for example, we're talking about Safaricom, we're talking about Equity Bank, we're talking about Cooperative Bank, or other organizations like East Africa Breweries Limited, Bamburi Cement. When you buy shares of a company, that makes you owner of that particular company. You become a co-owner of that company. So that returns that come from the profit accrued by the company and the dividends accrued by the company, you become part of it and you get to be an owner in the dividends and in the profits accrued by the company. These have got higher risks, but it has got very high potential. Why do we say it has got higher risk? Because of a particular company or the equity of a particular company, they can rise and at the same time the price can drop. So by the virtue that the price can rise or it can drop, that makes the investing risky. Then we have got bonds, government bonds. This we have got fixed bonds. So how does this happen? This happens when you lend money to the government. Look at for example, infrastructure bonds. Look at it when the government wants to invest to raise money for a project for infrastructural purposes. It will it will it will put out an order, of course, through corporations, a bid for it to raise money. And so the public will give money to the government, and then they'll be able to get returns after some period of time. So we have got real estate. This involves investing in physical properties, or even if you don't have the physical properties, we have got real estate funds where you money is pulled together and invested in a particular asset. Then finally, we've got so invest in real estate. It generates income through rental incomes, through properties that will appreciate over a long period of time. Then, so the next type of investments, these are commodities. What are these? Commodities are investing in physical goods like, for example, gold, oil, and agricultural products. This serves as an inflation hedge, and then prices fluctuate based on the supply and demand. You've got private equity. This involves investing in startups or private companies. It has got high risk, but it has got also high reward. Then finally, it requires significant capital and long-term commitment. And finally, we have got alternative investments, and this includes hedge funds, cryptocurrency, collectibles, for example, art, wine, and those ones we shall not put much of. So they have got higher risk and they're very complex, but they offer different diversification. And so roughly those are the types of investments that we shall be looking at. And what investment to go with will basically depend with what you want or what your goals for investments are. Some people will go for a particular investment because it offers them flexibility. Others will go for another one. For example, one will choose bonds, and another will choose government bills, and another will choose private equity because of different returns, because of different reasons. So it's essential that you understand the reasons for investing before deciding on the kinds of investment that you are opting to go for. That being said, let's now start looking at how do you set your investment goals. Investment is necessary, and as much as investment is necessary, it's also good that you understand why you are investing. Why are you opting to invest? And so this makes us look at investment goals. You need to have a reason for investing, because if you don't have a reason, you might pull out along the way. When you come across obstacles, as they will come when you're investing, when you don't have goals that push you, when you don't have um, goals that will make you to keep going, you might you might you won't have the motivation to keep investing. You won't have the motivation to keep going and keep your investment uh, going. So it's for this reason that you need goals. Now, before we start looking at goals, we shall have to understanding the risk tolerance. So risk tolerance refers to how the market fluctuates, how much market fluctuation an investor is comfortable with. For example, how much money are you willing to lose in an investment? So people who have high risk tolerance, have got those who have got moderate risk tolerance, and then you have got those who have got low risk tolerance. So high risk tolerance are those individuals who are aggressive, who are more aggressive. Moderate risk tolerance, this is a balanced mix of stocks, bonds, and real estate. Then you've got low risk tolerance. These are conservative investments like bonds and savings accounts. So these are the risk tolerance, and this risk tolerance makes investors, it categorizes investors also to be under those particular categories. There are people who have got high risk tolerance, others have got low risk tolerance, while others have got minimal. We have high risk and minimal. So we start looking at defining financial objectives. So your investment goal and then your investment type. If you're looking for a short investment term, for example, then you should be looking at savings, you're looking at bonds, you should be looking at money market funds. Medium term, and this is like 3 to 10 years, you should be looking at stocks, you should be looking at mutual funds, then you should be looking at ETFs. And then finally, for long term, 10 years plus, you should be looking at real estate, index funds, and private equity. It's important that we understand the time value of money, because money, a shilling today or a dollar today, is worth more than a dollar or shilling tomorrow. It's worth less as time actually goes by. If that money is not invested, that money will continue being less and less. And the reason this is due to inflation and potential investment growth. So what investing does is that investing early allows your money to compound over a long period of time, and such that interest will work on your favor. So a quick recap on what we've looked at in chapter 1. We've said that investing is wealth building strategy that involves calculated risk. It's a risk, it's risk involved. Then number 2, there are various investment types, each with its own risks, rewards, and profile. Then number 3, we have said setting clear investment goals, understand risk tolerance is essential for making informed financial or investment decision. So that was the introduction bit for investment course the introduction bit. So let's invest. I said we just mentioned them shallowly, but now we shall start looking at them in depth one by one, so that any person who's interested in investing will fully understand what to. So investing, understanding the stock market. The stock market as a marketplace where shares of companies are bought and sold. The same way you go to market to buy tomatoes and onions, for example. So the stock market is a place where companies go to sell their equities or their shares. In Kenya, this happens through the Nairobi Stock Exchange, commonly known as NSE. So how stocks are traded in Kenya? So we have got the primary market, then you have got the secondary market. So companies issue shares when an IPO. Probably you've had an IPO, initial public offer, e.g. Safaricom IPO in 2008. So when a company wants to the public to buy their shares, or when it opens up its shares to the public, one thing that it does is that it gives an IPO, an initial public offer, so that the public can participate. Secondary market, this is where investors trade stocks through a broker on the Nairobi Stock Exchange automated trading system. For example, you go to a bank, Equity Bank, KCB, NCBA, all banks are brokers. Most insurance companies are also brokers. There are also other brokers who are neither banks or insurance companies, but they act as brokers. So they act as mediators between you who is buying the stock and another person who is selling, of course, the company that is selling the stock. So stocks are traded under those two categories: primary market and secondary market. Who are the key players in Kenyan stock market? The key players, we have got a couple of them, but the key ones are: number one, the retail investors. This includes you and me. These are individuals who are buying the stock, or who are buying the stocks via the brokers. Key player number two, we have got investors, institutional investors, and this includes banks, pension funds, and insurance companies. The number three, we have got stockbrokers. These are licensed intermediaries facilitating the trades. For example, Faida Investment Bank, SBG Securities, and many other. And the number four, the last one, we have got regulators. Majorly the regulator that we all know is the Capital Markets Authority, CMA, that ensures that there's fairness in the market. It ensures that the investors are not defrauded of their money. It ensures that the stockbrokers and institutional investors play the investment game in a fairness manner. So there are a couple of stock market indexes in Kenya. So we shall look at the NSE 20 share index, the NSE all share index, or NASI, then the NSE 25 share index. So the NSE 20 share index, this tracks the top 20 listed companies by performance. For example, how has Safaricom been performing? How has Equity Bank been performing? How has KCB Bank been performing over a certain period of time? Then the NSE all share index, this tracks the overall market performance. Then finally, the NSE 25 share index, and this represents the 25 liquid and well-performing stocks. We go to 10 types of stocks on the NSE, on the Nairobi Securities Exchange. Then the core types of stocks are as follows. We have got the blue chip stocks, You've got the growth stocks, you've got the dividend stocks, you've got the penny stocks, then you've got the sector specific stocks. A brief overview at each of these ones. Blue chip stocks. These are stable and established companies. For example, Safaricom, Equity Bank, KCB Group, EABL, East African Breweries, and blue chip stocks are normally suitable for long-term investment, for long-term investing, because they are stable and they are well established and they have been in the market for a long period of time. Category of stocks number two, we have said this, the growth stocks. These are companies with rapid expansion. Look at the NCBA Bank as a platform that has been expanding onto the mobile money. And then we have got the, of course, I've mentioned NCBA Bank. This one might have higher potential returns, but may be riskier and a bit limited. Then finally, not finally, but you have got dividend stocks. These are regular profit sharing stocks, examples, BAT, Kengen, Cooperative Bank, and they're ideal for income focused investors. Penny stocks, these are low priced, high risk stocks. And the example for the Mumia Sugar Company, which was before its suspension, Uchumi Supermarket, they're highly volatile and they're only good for speculative purposes. And finally, we've got sector specific stocks. These ones are, for example, they're categorized because of them being in a particular sector. For example, when we talk about the financials, when we talk about energy, when we talk about manufacturing, when we talk about retail, they belong to a particular sector, they belong to a particular industry, so to say. Now, how do you buy your stocks? How do you buy stocks in Kenya? To buy stocks, I'll just take us through. You choose a licensed stockbroker. For example, the common ones are Faida Bank, Faida Investment Bank, Dyer and Blair, ABC Capital, and many others. Step number two, open a CDS account. A CDS account is an account that holds the shares. If a bank account holds money, then a CDS account is one that holds the shares. Step number three, so you fund your account, you deposit money via either M-Pesa or bank or transfers, or you do a check. Step number four, so you research on your stocks. So which stocks have been performing well? You have to do your research so that you are investing from a point of known. Then you place an order, you choose a market order. So immediately after you purchase at the current price or limit, so you set a particular price limit. Then finally, you just monitor and manage. You track your stocks through the NSE website, and over time, you keep looking at it to observe what is happening. There are a couple of stock investment strategies that we shall look at. Number one, we've got buy and hold. Number two, we have got day trading. Number three, we've got dividend investing. Now, what is buy and hold? Buy and hold, as the name suggests, so you're basically buying and holding investment in a long term. Like, for example, you're buying Safaricom shares and holding for a long period of time. Your day trading, this is short-term trading on volatile stocks that whose prices can go up or come down over a short period of time. Then dividend investing, this focuses on stocks with high dividend like BAT, Kenya. Stock valuation method. There are a couple of methods that are used to value stocks. But first of all, we let's look at understanding financial statements. There are terms that we have to familiarize ourselves with. The first term is this refers to company's revenue and profit over time. Balance sheet is the company's assets and liabilities as well as equity. Then cash flow statement, cash movements in and out of the company. Now, the following are stock valuation techniques normally used on the NSE. Price to earnings ratio, normally known as PE ratio. An example is if Equity Bank, for example, if the stock price is 50 bob and its earning per share is 10 shillings, the PE to ratio, we divide the price over the earnings per share. So this will be 5. Therefore, a low price to earnings ratio normally indicates an undervalued stock. Term number 2 is price to book ratio. What it is, and this normally measures a company's stock price relative to its book value. For example, a company's book value refers to the net worth of its assets as recorded in the balance sheet. And this is normally used by companies and banks such as real estate firms. Next term, dividend yield. If a dividend yield if for example a company like BAT pays 4 shillings per share in dividend and its stock price is 50, this dividend yield is 4 over 50 times 100, then it will be 80%. Then I've got discount or flow. So this is used by institutional investors to estimate the future earnings of companies like Kenyans. Finally, before we look at chapter 2, we shall look at portfolio management strategies. These are strategies that help you to manage your portfolio, and you have got diversification. Diversification involves putting your different investment in different baskets, so to say. For example, you'll buy some stocks under financials, you'll buy some stocks under telecoms, you'll buy some stocks under manufacturing, you'll buy others under retail and others under energy. Strategy number 2 is dollar cost averaging. This year, so this is where you invest a fixed amount of monthly to reduce the impact of price fluctuations. For example, regardless, you tell yourself this, regardless of what's going to happen, at the end of every month, I'm going to buy Equity Bank shares worth 10,000 or Safaricom shares worth 20,000. Another strategy is known as rebalancing your portfolio. This means that you're constantly adjusting periodically to maintain a balanced risk level. Then we've got risk management, as the name suggests. So this involves setting stock so that you sell a stock if it falls below a particular price. We have got growth and value investing. Growth stocks, so invest in high potential companies like Safaricom and Equity Bank, which have got strong revenue growth. So value stocks, you buy undervalued stocks such as KPLC, and then with over time, of course, their intrinsic value will increase. Then finally, you've got dividend investing for passive income. So this is where you focus on companies with a strong history of dividend payments, e.g. BAT, EABL. So you reinvest your dividends to compound returns over a long period of time. And so we've done chapter 1 and we've not. So a recap of, we've done chapter 1 and chapter 2. So a recap of chapter 2 is that the NSE, the main stock exchange, with top stocks like Safaricom, BL. Different stocks will suit different investment strategies. Then an investor must open a CDS account. You must open a CDS account for you to trade stocks in Kenya. Then stock valuation methods like the price to earnings ratio and dividend yield, they will help you identify which investment is good for you and which one is not good for you. Then finally, a well-diversified portfolio can protect investors from market price fluctuations. So that is it. We shall have chapter 3 in our next video, but this one we stop it here. I'm wondering whether we should continue to chapter 3. Okay, let's look at chapter 3. This one will be our last chapter, and then we shall have other other videos in the same series. Now, chapter 2 has been bonds, has been chapter 3 is bonds investing. What are bonds? A bond is a loan, and it's a loan made by an investor, for example, an investor to a government or a corporation in exchange for a periodic interest payment and the payment of the principal amount at maturity, after a certain maturity period. Bonds are fixed income investments because they provide regular interest payments. Now, why invest in bonds? Bonds will give steady income. Bonds have got a very low risk. They enable you to have a diversified portfolio because you can invest in stocks, then you invest in bonds, then invest in other assets. Then bonds help in capital preservation so that your capital doesn't get lost. So who issues the bonds in Kenya? But in Kenya, bonds are issued by Central Bank of Kenya, CBK. Investors can buy bonds through auctions, through banks, or through licensed brokers. There are three core types of bonds. We've got government bonds. Government bonds are low risk. They are guaranteed by the government because the government of the day will always be there. When the government wants to raise money, it will give out. Okay, so we shall look at it deeply. Then we have got corporate bonds. These are issued by corporations. Then you have got infrastructure bond. So government bonds, these ones are issued by CBK, one. Then number two, they are normally used to fund national projects like infrastructure, like health, and many other. A very good example, we've got the treasury bonds, also known as T-bonds. These ones are long-term bonds, 2 to 30 years. Then we've got treasury bills. I call them T-bills. These ones are short-term. They fall under the 91-day category, 182 days category, or 364 days category. Corporate bonds, these ones are issued by corporations or companies, and the purpose of raising capital typically, and they normally pay higher interest than the government bonds. Examples, we've got Safaricom that issued the green bond that was launched in 2019 to finance eco-friendly projects. Then East African breweries, EABL, corporate bonds used to expand the operations. Then you have got infrastructure bond, finally, normally issued for major development projects. They accrue higher interest. For example, 14%, 15%, all the way up to 18%. They are normally tax-free for Kenyan investors. A good example is the 2023 CBK infrastructure bond, which had a 14% interest rate. How are bonds valued? So bond valuation and yield. How are bonds priced? Bonds can basically be traded at a face value, or premium, or a discount based on the market demand and interest. A good example of a bond yield is the following calculation. When you buy a Kenyan bond at maybe 100,000, which has got a 12% annual coupon rate, so that's the rate at which you'll be paid. So your annual return will be 12,000 before taxes. Then you subtract 15% of the withholding tax. So it will get 85% of the 12,000, and then you get 10,200. So the total money that you will earn, you'll get is the 100,000 plus the 10,200. Now, what is the coupon rate? These are fixed interest paid on bonds, e.g., on a 12% on a 10-year treasury bond. The yield to maturity, this is the total return that is expected if the bond is held to maturity. If you are buying a bond for 10 years, for example, 12 years after it has matured. So the amount, the yield is referred to as the yield to maturity after the that particular time is has matured. These are the risks involved, risks associated with bonds. When investing in bonds, every investment basically has got risk, and so we've got the credit risk, interest rate risk, inflation risk, liquidity risk, reinvestment risk, and then call risk. How do we invest? How do you invest in bonds in Kenya? No, now we shall look at it under the three categories. How do you invest in treasury bonds? You can invest in treasury bonds, you can invest in treasury bills, then you can invest in corporate bonds. So when investing in T bonds, the bonds are sold via the CBK auctions. This one is done every month. The minimum investment is 50,000. So investors, you apply through the commercial banks or through the brokers that we've talked about. When you go to treasury bills, on the other hand, these ones are short term. You can invest in a 91-day period, 182 days period, or 364 days period. They are sold at a discount and paid at a face value on maturity. For example, if you buy a 364 treasury bills for 95,000 on a maturity, you receive 100,000. When you want to invest in corporate bonds, these bonds are bought through the NSE, the Nairobi Security Exchange, so, and companies will issue these bonds through public offers. The higher interest rates, but they give higher risks as well. You can as well invest in infrastructure bonds, or you can invest in secondary market market trading. So this is a summary of chapter 3. We've talked about that bonds provide stable income and are less risky than stocks. We said that treasury bonds and bills are safe investments and are managed by CBK. Then you have said that infrastructure bonds offer higher returns and are tax free. Then corporate bonds have got higher returns, but they have got very high risk. Then finally, we've said that investors can buy bonds through CBK auctions, through banks, or through the Nairobi Securities Exchange. So our stream will stop there for today. We shall pick up from chapter 4 during our next stream, where we shall start looking at real estate investing. Until next time, thank you for sticking with us up to this particular time.